Something is off, and you can feel it even before the chart loads on your screen. The silver market is showing one message on the surface while quietly printing a completely different message inside the physical reports behind the curtain. Before we even step into the metal itself, I need to say something clearly, calmly, and with full respect for your time. John O.G. might disappear from this platform one day, not because we did anything wrong, not because the analysis is inaccurate, but because the internet has a strange habit of multiplying things that work. Right now, there are too many imitation channels using the John O.G. name, copying thumbnails, copying titles, copying the tone, copying the format, replicating the branding until the platform algorithm starts seeing the same identity repeated across dozens of lookalike channels. When that happens, automated systems don't always distinguish between the original and the clones. They simply see duplication. And when duplication crosses a certain threshold, the system sometimes swings wide. That is how real creators occasionally get caught in the same enforcement net that was meant to catch the imitators. So this is not panic. This is simply logic. A clean backup channel now exists called financial capital. Think of it the same way you think about moving bullion out of a crowded counterparty chain into a vault that you personally control. The metal doesn't change. The discipline doesn't change. Only the container changes. If the algorithm ever confuses the signal with the noise, the analysis continues there without interruption. Now let's talk about the metal itself, because the silver market right now is quietly flashing a number that should make you stop scrolling for a moment. 528,691 now 365.40 ounces. That is the ounces in trust figure printed in the iShares Silver Trust fact sheet as of December the 31st, 2025. Not speculation, not a rumor circulating on social media, a formal documented number inside a published report. Why does it matter? Because it represents the scale of silver exposure the public can access instantly through a paper wrapper with a single buy button. At the same time, the delivery system for physical silver operates on a completely different set of numbers. And that contrast is where today's story begins. This video is not about whether silver is up or down on a chart today. This is about why silver can appear weak on a screen while simultaneously feeling tight inside the physical pipeline that actually moves metal around the world. Silver doesn't have one price, it has layers. Spot quotes, futures contracts, exchange-traded funds, physical bar premiums, warehouse inventory categories, monthly vault updates, different timestamps, and different reporting rules. Most people mix these layers together as if they represent the same thing. They don't. Paper silver moves at the speed of a keystroke. Physical silver moves at the speed of logistics. Now look at the screen layer. The live silver quote shows a bid around 84.62. and an ask near 84.87 with the days range stretching from roughly 83 to nearly 89. On the same board, gold prints north of 5,390 with a wide intraday range as well. Those are the numbers everyone sees, the numbers that get screenshotted and shared across social media before anyone stops to ask a more important question. What is happening underneath the number? Because underneath that surface price sits the futures arena. Silver futures represent the part of the market where leverage amplifies everything. The contracts trading for the May cycle show open interest around 78,000 contracts. That number matters because it tells you something simple. The arena is full. And when a crowded arena suddenly tries to exit through the same door at the same time, prices can move very quickly regardless of what is sitting inside a vault. Every one of those contracts represents a bet. Every bet has two sides. When sentiment flips, liquidation doesn't politely file out one by one. It stampedes. Now add the dollar. Because metals live inside the shadow of the currency they're priced in. The US dollar index hovering around the 99 area may not look dramatic, but even small movements in the dollar can act as catalysts in leveraged markets. When the dollar firms even slightly, assets priced against it suddenly feel heavier. That means paper silver can fall quickly, even if nothing about the real-world supply of silver changed that day. And this is where most retail observers get confused. They see the price drop and assume the physical world must also be loosening. Sometimes it is, sometimes it isn't. To understand the difference, you have to look behind the curtain. Inside the COMEX warehouse reporting system, silver inventory is divided into categories: registered metal, eligible metal. Registered silver is metal that is already warranted for delivery inside the exchange mechanism. Eligible silver meets the specifications, but is not currently committed to delivery. Both are real, both exist, but psychologically, they carry very different weight when stress enters the system. The latest depository reports show roughly 78 million ounces in the registered category, while the eligible category holds significantly more. Combined, the total inventory reaches into the hundreds of millions of ounces. But the line that deserves attention isn't the total, it's the flow. On one activity date alone, the report recorded a withdrawal of roughly 768,000 ounces. That number doesn't automatically mean shortage. Warehouses move metal constantly. Classifications change. Bars get shifted between categories. The important point is not a single withdrawal. The important point is patterns. Because while paper silver can fall during a dollar bounce, the physical system can simultaneously show metal leaving certain pathways. Both events can occur in the same 24 hours. Once you understand that, the silver market starts making a lot more sense. Now zoom out to London. The LBMA vault system acts like the global reservoir for precious metals. The latest data shows tens of thousands of tons of silver sitting inside London vaults. That number is massive by any standard. But even that reservoir drifted lower in the most recent update, declining around 2.4% month over month. And here's where the difference in clocks becomes important. The screen clock moves every second. The vault clock updates once per month. Retail investors usually watch the fast clock. Professionals watch both. Now bring the ETF layer back into the conversation. The iShares Silver Trust trades like a stock. Anyone with a brokerage account can buy exposure instantly. That is where the 508 million ounce figure becomes meaningful. A massive amount of silver exposure exists inside that vehicle. Meanwhile, the delivery grade categories that traders monitor during stress periods are much smaller. That difference doesn't automatically mean catastrophe, but it does mean something important. Sentiment can move faster than logistics. A crowd can reposition its paper exposure instantly. Physical metal cannot be mined, refined, transported, and fabricated at the same speed. Now let's bring gold into the picture. Gold acts like the reference point for the entire precious metals complex. In many ways, gold behaves like financial collateral. Silver behaves like collateral and industrial material at the same time. Because silver wears two hats, it often falls harder during risk-off moments. When investors reduce risk, they frequently sell the more volatile asset first. That behavior shows up clearly in the gold-silver ratio. When the ratio rises, silver is underperforming gold. When the ratio falls, silver is gaining relative strength. Watching that ratio over weeks tells you far more about market psychology than watching a single day's chart. Now add one more layer most people overlook, and once you understand that difference, the market stops looking irrational. But honesty requires presenting the bearish side too. Silver is volatile by nature. When the dollar strengthens and risk appetite fades, leverage positions unwind quickly. Futures traders reduce exposure. ETFs fall alongside the futures price. The gold-silver ratio rises. In those moments, it can feel like the thesis is broken. New demand pipes. A recent example involved a large purchase of tokenized gold representing physical metal stored in vaults. Products like tokenized bullion, blockchain-settled gold, and digital commodity exposure are opening new channels for institutional capital to access metals. Those pipes can move capital extremely fast. The reservoir of physical metal does not expand at the same speed. And that mismatch between financial demand and physical logistics is one of the reasons silver becomes volatile during certain phases of the cycle. But silver isn't only a monetary metal, it's an industrial one. Solar panels, electronics, medical equipment, and advanced manufacturing all require silver in refined forms. Recent industrial data from China shows refining costs moving sharply, which suggests increasing friction in the processing pipeline. When refining costs rise, the price of turning raw metal into usable industrial silver also rises. That means the screen quote might decline while the real-world cost of producing usable silver products remains firm. Two realities can exist simultaneously. The quote reflects sentiment. The pipeline reflects logistics.